Hi, this is Greg Kite with Championship Wealth. Do you want to know a secret? Everybody likes secrets. I've got some secrets to share with you today. If you've been here with me on some of my other videos on this channel, maybe you've started to learn about the laser fund.
Favor of the Lakers. Right now, let's go to James Brown. And Greg Kite was tagged.
Liquid assets safely earning returns. So what is a laser fund? It's a maximum funded index universal life policy, and it's got some secrets. I'm going to share those with you today, and one of them is what we call laser banking. But first, secret number one that's so powerful about laser funds is that you can eliminate taxes and losses. The money that you have in a laser fund can grow tax-free, you can access it tax-free, and then it can pass on to others tax-free. It also allows you to grow your money without the market roller coaster, with no market risk, where you can get excellent returns without the ups and downs and emotions of riding the market. Secret number two, you can optimize your gains. By actively managing, working with an IUL professional like me, and rebalancing your account through indexing strategies, you can optimize gains. We often see IUL funds returning 7 to 10%, and with some years even as much as 15% or more. Maximizing and optimizing gains with IULs is a tremendous secret. So for our third secret, as I mentioned too a little bit before, just as a teaser, you can have tax-free income. We look to take an IUL, a laser fund, to maximum fund this. Sometimes it's done over a number of years. Often, like you see in the picture here, it's done over 4, 5, 6 years. Kind of like having your own, if you had your own office building, how fast would you want to fill up that office building or apartment if you could? And once you have it filled up, leased out totally, you're going to maximize your money. So we're looking to maximum fund these laser funds for tax-free income. The fourth untold secret is leverage. Safe, positive leverage is a wonderful thing. It's one of the great financial tools that is out there. So I'm going to show you a little bit more about laser banking, how you can become your own bank. Now, when you think about accessing money from traditional accounts, how does it work? So let's say you had an account balance somewhere of $1 million. It could be $100,000. It could be $10,000, whatever size account. Once you take out some money, in this case, if you took out $100,000, then you're left with $900,000, correct? So you've taken out 10% of that, the balance of that account. However, when you access money from a laser fund, that maximum funded IUL, you keep earning compound interest. A little bit hard to grasp, but it's one of the miracles. One of the wonders of the world has been said is compound interest, but an even greater wonder is tax-free compound interest. So how do you keep earning compound interest? Well, you can do that by accessing money from a laser fund via policy loans. So let's look at this example. If you had $1 million in accumulation and cash value with a 10% index growth, each year you get credited some interest, depending on the strategies that we help to structure for you. Get credited interest on that plan, on that laser fund. That 10% growth on $1 million would be $1,100,000. Then if you wanted to access $100,000, the wisest way to do it is via a policy loan. There's actually 3 ways to access money from an IUL. Well, we touch on those as call those the dumb way, the sad way, and the smart way. And this policy loans is a smart way. Watch some of our videos for more on those other 2 ways. But via a policy loan, what happens is you've taken a policy loan of $100,000. Your cash value or your liquidity in the policy's gone down to $1 million, but your accumulation value still stays at $1.1 million. And it's that accumulation value that the index growth, the interest that's being credited to you, is credited on that accumulation value. So your accumulation value, 10% growth on that $1.1 million would mean that after the next crediting period, you'd have $1,210,000. Now, policy loans do have interest that come with them. They vary, but typically they're often around 4 to 5%. So with a 4.5% policy loan interest on $100,000, your policy loan balance in time would grow to $104,500. So once you subtract that from the accumulation value, your cash value has actually grown, even though you accessed money. It's grown to $1,105,500. That, again, that cash value is your liquidity value, the money that you can access other policy loans are, or if you wanted to, the not so smart way, we'll call it, withdraw money out of your account. So what's a laser bank? Well, a laser bank is using this laser fund to be like your own bank. We've got some different plans. We're going to probably just touch on one of these today, and we'd love to see you come back as we take a deeper dive into some of the others. But they're the Financial Freedom Plan, the Wealth Builder Plan, and the Business Builder Plan. So let's take a look on the Financial Freedom Plan. It's a great way to eliminate unwanted debt, the smartest way to eliminate debt, the quickest way possible. The Wealth Builder Plan has to do with real estate. Your real estate can be multiplied by using a laser bank. You can even get to where, and stay tuned for one of my future videos on how your rental properties can still earn money even when they're vacant. And then finally, a Business Builder Plan. Your businesses that you have and operate, the growth of them and the value of them and your assets can be multiplied by using a laser bank. So let's look at laser banking on how to accelerate debt elimination. In this example, this Financial Freedom Plan, you've got some debt. You want to eliminate the smartest and quickest way possible. So this is an example. You're age 52, you're going to retire at age 72. You got $25,000 in savings, and you're putting away $100 a month into that savings. You've got a 401k or an IRA of $75,000, and you're adding $6,000 a year to that. You've also got an old whole life insurance policy. That's a $250,000 value, or death benefit, I should say, on that whole life policy. Your premium that you're paying is $250 a month, and you've got an accumulation value, a cash value of $18,000 in that whole life policy. So, but you've also got some debt. So let's look at on credit card number one, you owe $18,000. They're charging you 22% interest because they can, and they do. Credit card companies make a lot of interest and charge a lot of interest, and that payment is $500 a month. Credit card number two, you owe even more, $36,000 at 18% interest. You've got a $1,000 payment with a $400 a month minimum payment. You've also got a mortgage, a third debt. Your mortgage is $385,000. It's at a 3.85% interest rate, and your principal and interest payment is $2,200 a month. If you wanted to pay those off by those traditional methods, it would take you 60 months to pay off credit card number one, 177 months to pay off credit card number two, and 232 months to pay off the mortgage. So let's look at how to eliminate that debt that you have the quickest and most efficient way possible by using this laser banking method with your own laser fund. To do this, we're going to reposition some of the lazy assets, the tax-deferred assets that you have, and the money that's going into those assets to help you, one, grow your wealth, at the same time quickly and efficiently eliminating your debt. So in step number one, you've got your savings. You've got $25,000 in your savings bucket. You're putting away an extra $100 a month in savings. Step two, you've got your IRA. You got $75,000 in that IRA, and you're contributing another $500 a month to that IRA. And finally, with step three, you've got your whole life policy with the $250,000 death benefit, the cash value in that, and you're paying $250 a month in premium. So what we're going to do, we're going to combine those payments plus some of the cash that's in those three assets and put those in a laser fund. So you see there in year number one, we've got an initial premium of over $35,000 that gives you a death benefit of $495,000, more than you have with your whole life policy originally. And then in year number two, we're going to continue to pay premium. We're going to pay premium on this, as you see in years one 1 through 20 over here on the left. Okay, we're going to pay premium until you retire, in this example at age 72. But then in year 2, we're going to take a policy loan. So let's look at your laser bank now. This laser fund that's set up, we're going to fund this with some of these dollars that are in those assets, those 3 assets that you have, and for the dollars that you're contributing there. So the first year at age 52, over here on the left, you see the year column, age 1, or year 1 through 22 in the chart you can see here. And then your age 52 through age 73 on this chart. What we're going to do is fund that laser fund with $35,000 of premium in year 1. Some of that's going to come from your whole life policy. Others going to come from your other assets and from your monthly contributions. That will give you a new death benefit on this new laser fund policy of $495,000. So if you died too soon, you passed away, your beneficiaries, your loved ones will receive all of that death benefit tax-free. But to start the debt elimination in year 2, we're going to take a policy loan. That policy loan is going to be $15,741. We're going to use that to pay off credit card number 1. And then in year number 2, we're still putting in premium each year. You see $17,412 in year 2, year 3, etc. But we're going to take another policy loan and pay off that credit card number 2 in year 3. So in essence, you've got your own bank here. You're accessing money. Your money's growing based on the accumulation value, and then your surrender value is your liquidity value. So you're getting interest credited. So if this policy is earning 8% or 10% or whatever it's averaging over time, that's all based on your accumulation value. And your policy loans are at a lower rate than that, so you have a positive spread on that money that you're borrowing out to pay off those other debts. Then you'll continue to pay on your mortgage, but then in year 11, once you've had it, we've paid down your mortgage a little bit more, and we've built up enough cash in your laser bank. We're going to take a policy loan of $143,000 in year 11 at age 62 and pay off your mortgage. Okay, so you see at that time, even after year 11, you've got an accumulation value of $247,000. You've got liquidity value, surrender value of $91,000, and $339,000 in death benefit. At that time, though, after that, we continue to contribute premium till age 72 is in this example. Your debt's all paid off, and we'll find out here how soon that's paid off, looking at this all together outside of this illustration here. But then at age 72, you're retired and you want to start taking income. So you see here in this column, policy loans, we're going to take $45,000 in tax-free policy loans per year to supplement your retirement income. And not just do that for the next 2 years, but do that for the rest of your life. And at the same time, while you're doing that, you can see down here at the bottom of the chart too as well, your accumulation value is still growing, your surrender value, that being your liquidity amount, still growing, and your death benefit is still very, very large, actually larger than what you started with. So you've got the best of all those worlds. You've had great growth, you've got access to money tax-free via the policy loans. You've used those policy loans to pay off your consumer debt and your mortgage debt that you had, and you've got that protection for you and your family where that money will transfer tax-free upon your passing. So again, the goal with your laser bank in this situation, your financial freedom plan, was to eliminate your unwanted debt the smartest and quickest way possible. So let's revisit a previous slide. You had your credit card where you're paying $500 a month. You had your second credit card where you're paying $1,000 a month with a $400 minimum. And you had your mortgage where you're paying $2,200 a month. And remember, it was going to take you 5 years, 60 months to pay off credit card 1. At that rate, credit card 2 is going to take you 177 months, almost getting close to 15 years there. And your mortgage, almost 20 years to pay off that mortgage. So instead, by using the laser fund, we've cut that down significantly. We've got the credit card number 1 paid off in 2 years. We've got credit card number 2 paid off in 3 years. And then we've got the mortgage paid off in year 11. The quickest and smartest way to eliminate debt is using your laser banking with your own laser fund. As I mentioned, stay tuned to this channel for more videos. We're going to take a deeper dive in the future about how to become your own bank using laser banking to build wealth with an IUL in real estate. And then in another episode, how you can use laser banking to become your own bank and how to use your IUL for business capital to enhance and grow the value of your business and your personal assets. If you enjoyed this video, please like it, subscribe, and comment down below. I'd like to hear your comments down below on your thoughts about laser banking to pay off debt and your experiences in paying off debt. If you're intrigued and you want to learn more, here's a few ways that you can do that. One, you can reach out to me through our website at championshipwealth.com or on one of the links below to get your free copy of the Laser Fund. You can also schedule a consultation with me or one of our IUL experts, or you can join us for one of our future events like webinars and workshops that we have online. Thank you, and I look forward to seeing you again at our next Championship Wealth tip-off video.